Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Joining us now, I'm so pleased to say, is Stephen Meier, Chief Investment Officer for the New York City Retirement Systems. Stephen, it's wonderful to speak with you as someone who has to be an adjudicator of the national policies of how we invest for public servants. How do you understand the confidence, the bullishness in a market that is really hinging on such narrow leadership?
Well, I think if you look at the markets right now, you're right, there's no breadth, and clearly there's some real concentration risks. People talk about American exceptionalism. I think it's the artificial intelligence halo effect that we saw last year spilling over to this year. So we look at it from a standpoint of it's really mega cap exceptionalism. What we do, though, we're long-term investors. We manage diversified portfolios that are resilient and made to perform in different types of environments. So we're more strategic than tactical. We're not actually trading. Having said that, we have recently done strategic asset allocations across the 5 plans. We are reducing our exposure at the margin to U.S. equities, large cap in particular. We're flat to maybe down a little less in non-U.S. equities to fund increased investments in private assets.
Within those private assets, because I know you made an announcement to start this year that you would start increasing your allocations. How are you thinking about real estate within that? Because there's still trouble. MSCI said $38 billion worth of office buildings were still in distress. Surely it's only going to be worse with stubborn rates and loans coming due. Have you pulled back your exposure on real estate specifically?
Not necessarily, Danny. We have obviously a diversified portfolio. We're in non-core and core real estate investments. If you look at our investment portfolio right now, it's about 31% multifamily in real estate, probably about 36% in industrial logistics. So we're diversified away. We have an underweight, intentional underweight in retail and office space in particular. I think it's another 2 years in terms of those situations working out at least.
Another 2 years. So how do you want to be positioned for 2 years? I mean, do you pull out completely when that comes due? That is a scary prospect, because again, what we've seen is this rolling default. It's not this one big event, it's this continued issue. So what does that look like in 2 years?
Yeah, for us, it's more around putting money to work, putting new money into the sector. So obviously we're not forced sellers. We don't need to be a seller. We're long-term investors, again, with a much longer-term horizon. So we're not panicking, but we're also not stepping in at this point. I know there's some smart people out there that think, well, where valuations are and prices are, it's probably close to a bottom. I'm a little suspicious. I think that has a little more to go.
Elsewhere, if it is higher for longer, if it is we're not going back to a zero rate environment, are there other investments that you've had to rethink, things that just frankly won't work in this environment going forward?
Well, I'd say we focus more on fixed income as a core holding in the portfolio. So if you look at the yields you're able to get both in private and public fixed income now, it's obviously more compelling than it was in a zero interest rate environment. I also think the zero interest rate environment was very negative for the markets. I think it actually leads to suboptimal investment decision, over leverage. Another concern I have just where we are right now, we've got leverage around the world at 225 to 250% of global GDP. I think that's going to be more of a challenge, I think, domestically and abroad.
How concerned are you about the deficit then, given your last point? Are you in the Steve Eisman's camp of, as Lisa would say, oi, the deficit?
Yeah, I am concerned about the deficit. If you just look at the trajectory of the deficits that we're racking up, we've got, about 98% of outstanding U.S. Treasuries relative to GDP, expected to go up to about 116% of GDP in the next 10 years. Those are dangerous levels. And just the amount of paper we need to roll consistently through this auction process. I know, Lisa, you follow the auctions. We had a couple good auctions this past month.
We did.
10s and 30s went okay, 3s not so well, better than 2s, 5s, and 7s last month. I think it's worth watching because I think there's a lot of information coming out of those auctions. And I do think the size of the auctions are going to be a headwind for the markets. It's a risk factor for investors.
Can you give us some perspective? You said you just shifted your asset allocation to focus more on private assets. Was that away from equities? Was that away from bonds? Was it away from both? I mean, how does it sort of break down now versus, say, 2 years ago?
Yeah, so we're operating under somewhat of a constrained opportunity set. So we had a limit up to only 25% in private assets. That's now been increased to legislation to 35%. So we were a little overweight in global equities. We pulled those positions back a little bit, mostly from U.S. large cap in particular. But we still see a lot of opportunities out in the private asset sector. We think that's a growing area of interest. A lot of people have pulled back because they've been overdone. We've seen opportunities in secondary sales. So we're actually continue to put money to work, I think, very proactively in those spots. We like private credit. We think the private credit is actually compelling in terms of, obviously absolute returns in terms of base levels higher. Most of those obligations are floating. We've got SOFR, 3-month SOFR, 534. So we have a 7% actuarially assumed rate of return, or benchmark, and I'm proud to say so far, fiscal year to date, we're ahead of that. But we got another eight or 9 trading days, so we'll see where we wind up.
There has been this widespread criticism of private credit that they've been in this extend and pretend mode, that they've just been waiting for rate cuts. And until that happens, they've been very lenient to those that they've been lending to. But at some point, the music stops. Do you share that concern? And how careful have you been picking managers, if you do?
Great question, Danny. So I think you have to be really careful. There's a lot of new entrants into the private credit markets. We tend to focus on the Ares, the Apollos, the Oak Hill Advisors of the world. We do most of those investments through separately managed accounts versus GPs or as a limited partner. We still see good opportunity there, but you really would need to pick your managers. We also like more opportunistic funds that can toggle between public and private, where they think the valuations are cheaper.
Well, that gets to this other part of the industry that the small players can't survive anymore, that in private assets it's just the big getting bigger. As an asset allocator yourself, is that what you expect? Do you expect that the smaller players are not going to have that demand and some sort of consolidation needs to happen in this industry?
I don't know. I think, obviously because of our size, we have the privilege of managing about $280 billion in assets. We tend to gravitate to the larger managers. I think the difference for us this year is there's been a lot of pullback on the part of other public pension plans and institutional investors. So we're able to get better access to the better managers and negotiate much better fees, co-investments, in terms of averaging down the cost of those transactions.
So just to say, today we're talking about retail sales, we're talking about Fedspeak. Do you watch any of that? Do you care? Or is it sort of, noise as you focus on ways to uncorrelate yourself from it all?
Lisa, I shouldn't watch that, but of course I watch that. and I'll tell you why. Obviously, our underlying beneficiaries and participants watch that. We get questions all the time. My trustees call me all the time and say, what's going on in the market? People are concerned. How do you feel about things? So we watch it. We watch it also as a matter of managing and monitoring the performance of the funds. Are they managing to expectation? But yeah, we focus on all that. We're in the markets, but as I said earlier, we're not tactical, we're more strategic, we're long-term, but we do care what happens in the short term as well.
Stephen Meier, wonderful to see you. Thank you so much for being with us. Really great to hear what you have to say. Stephen Meier of the New York City Retirement Systems. Shepherdson of Pantheon Macroeconomics, and Greg Daco of EY. Greg, I want to start with you. Both of you, Ian and Greg, are talking about how the balance of risks is we are seeing real weakness, and this is just a tipping point that is going to deepen. What do these retail sales do to kind of edify that feeling of yours?
I think what they indicate is an environment where you're seeing a bit of a more caution, more prudence on the part of consumers. And this is not new. We've been seeing consumers be a little bit more careful, be a little bit more sensitive to higher prices. This cost fatigue that we've been talking about for a few months now is now starting to be visible in the data. We're seeing a little bit more caution when it comes to outlays. When you adjust outlays for prices, you're actually seeing a contraction in retail sales on a year-over-year basis. Service sector spending is still relatively strong, but we are seeing more caution. And the key reason for that additional caution is the fact that you're seeing some softening in the labor market. Not a retrenching, nothing alarming, but a bit more caution in the labor market as well.
What's the gap in between a bit more caution and true weakening, given that this is 2 straight months and pretty negative downward revisions as well?
Yeah, the downward revision is disconcerting because it sounds to me like the control group now is essentially flat over the last couple of months, and had been weakening before that as well in terms of the growth rate. So this is beginning to start to look like an entrenched softening. I mean, not a rollover. You know, it's not a disaster by any means, but it's very different to what we saw last year. Remember the second half of last year, we're looking at constant upside surprises and the consumers charging along at 3% real through the whole second half of the year. We're not going to do anything like that in the first half of this year. And I think a part of the reason here is as well as the labour market weakening, which is definitely real. You can see in the surveys that people are getting nervous about job security for the first time in this cycle, but they've also got less cash flow. You know, real income growth after tax is a lot lower than it was this time last year. Payroll growth is lower, wage growth is lower. There's just less cash around. And so people are just being a little bit more cautious at the margin. If you're a bit more cautious at the margin for a few months, it starts to build into something real.
And what it really speaks to me is if we have this price fatigue, is do corporates have pricing power anymore? We have seen some of those margins start to thin. So if we're in a world where corporates are having thinning margins, you don't have that labor constraint that you once did. Is this, as Jan Hatzius over at Goldman Sachs says, an inflection point for the labor market?
It's an inflection point for the labor market for sure, but it's also an inflection point for the inflation story as well. Because that margin expansion that we saw during the pandemic and in the year afterwards was a huge driver of the increase in inflation. And most businesses have held on to those margins, but if they're starting to crumble now, so we're actually seeing them come down rather than just hang around the highs, if we start to see them come down, it really does change the inflation picture because it was a really big part of the inflation story that's not kind of widely appreciated, but it's why I think core inflation next year goes below the Fed's target because of margin compression, and it's just beginning to creep in.
Greg, what do you think about that? Is this an inflection point?
I tend to believe so as well for inflation in particular because we have seen more pricing sensitivity on the part of consumers. We're also seeing markups fall. We're in deflation territory when you look at some of the PPI indices for consumer pass-through. And we are still seeing some disinflationary currents in terms of the rent inflation side, and wage growth is also moderating. Put all that together, and all of the fundamental indicators in terms of inflation are pointing towards further disinflation. So if you have a forward-looking perspective, that is the right type of mix that you want to see from a Fed perspective in terms of easing monetary policy, not to bring rates down to zero, but to recalibrate monetary policy to today's reality.
So does December make sense in that scenario?
I think September makes sense. I would have actually thought that July made a lot of sense, even potentially June. You're not talking about cutting rates down to zero to stimulate the economy and prevent a recession. You're talking about how do you recalibrate monetary policy for an environment where inflation, PC inflation, core PC inflation, is within striking distance of the 2% target, likely to be around 2.6% in May. That is a point at which you want to start considering recalibrating monetary policy to have the optimal framework in an economy, as Ian was saying, where the labor market is gradually cooling, where wage growth and payroll growth are cooling, and where inflation is moving in the right direction.
We do hear from the New York Fed President Williams also speaking right now, actually. He's talking about that they're going to be data dependent. Well, if they are data dependent, and this is the data, do you think they need to take another look at their dots and the
absolutely.
timeline?
Greg and I are going to have an agreement fest here. but I honestly, I wish they'd cut rates last week. And they didn't, so I wish I'd cut them in July, but they probably won't. What worries me here is that they're very backward-looking, and they're constantly talking about what the data have been doing. And there's not enough discussion from the Fed about where the leading indicators, of which the US has an abundance. I mean, we have dozens of reliable indicators of the labor market, consumers, everything. And they seem to be resolutely ignoring them in favor of looking at the backward-looking stuff. And if you carry on doing that, then by definition, you're going to be late when you start cutting rates. And the danger then is that you end up with the economy slowing more than it needs to for longer than it needs to. So I think a bit of courage here maybe, and to say, okay, we don't have to wait until we're 100% certain inflation is going to get to the target, but to be reasonably sure now, I think is a pretty solid case. You know, the core PCE over the next few months, you know, is going to be 2 something, and it's not a million miles away, and yet rates are still at the highs.
If you are just joining us, we did get retail sales about 9 minutes ago, and you can see they came in across the board lower than expected, with downward revisions across the board as well to the prior month. You could see the headline coming at 0.1% versus the expected 0.3%, and a decline in the prior month of 0.2%. Looking under the hood at exactly what was driving this is actually interesting, and it speaks to some of the home builder story that we were talking about earlier. Furniture and home purchases were down 1.1% on the month. You can see building materials down 0.8% on the month. You could see this pretty much across the board. What are the parts that bolstered this retail report? Vehicles and parts, 0.8% gain. Auto dealers, 0.8% gain. You could see gas prices going down. That's gas station, 2.2% decline. But sporting and book costs, 2.8%. Glad to see that people are buying books. To me, this sort of raises this question, Greg, about how much the suppressed housing market, some people might argue the broken housing market, is suppressing retail sales in a way that's distorting the data and frankly could rebound really substantially if rates come down, people buy homes again, they find it accessible. Is this sort of muddied data that's being skewed by otherwise kind of broken housing markets?
So the housing market's certainly frozen, but I'm not sure you're going to see a massive reacceleration in the housing market unless you see one of two things, or one of three things. One, prices falling quite dramatically. Two, interest rates falling quite dramatically. Or three, income growth accelerating quite dramatically. As Ian was pointing out, we have real disposable income growth that's currently at 1%. That's a really low number. You have home prices that are still high and still coming up higher and higher given the lack of supply. And you have interest rates that are unlikely to fall back quite massively given that the Fed is likely to maintain this higher for longer monetary policy stance. So I don't see that as a potential for a comeback. And if you look at the underlying drivers of consumer spending here, you have income growth that is still moderate, you have a low savings rate, and you have wealth growth that is not accelerating as much at the same time as credit is tight. So you have this bifurcated outlook for consumers where the lower end, younger generations, more indebted consumers are struggling to make ends meet in this environment.
Ian, to the point of bifurcation, I wonder if we look at this data, if again, maybe it doesn't accurately capture things if there's this housing confusion, but also the bifurcation. If you're looking at the richest people who essentially just buy assets, they buy assets, they're investing in the stock market. Does something like this give us the full picture, or is it really just capturing what we know has already been under pressure?
Yeah, I mean, the lower end of the income distribution is now under stress in a way that they haven't been since way before COVID. I mean, the fiscal stimulus, the checks in the mail that we got through the pandemic was a huge support to consumer spending, and especially for that middle and lower part of the income distribution. You're right, at the top end of the distribution, you know, cash flow is not really important. It's all about asset prices. But the variations in consumer spending are driven by the actions of the middle and lower. And so if those people are now seeing much slower income growth than they saw last year, and they're beginning to worry a bit about job security, you know, the New York Fed survey asks people, do you think unemployment's going to go up? Are you worrying about job security? And those measures have both gone materially higher. So that's not a great combination. You know, that's a combination that tends to make people save more because of worry, but they're saving more from smaller cash flow, which means spending gets hit harder. So this is, you know, again, we're not at the point where everything's falling apart. That's not the story here, but we are, I think we've got to get out of the mindset that, you know, it's just been constant upside surprises from the consumer. Well, not anymore.
When you look at the bifurcation, and I know you pay attention to the surveys, do you see a real hollowing out of the middle class?
I think that's probably going a little bit too far. You know, we've seen very strong job growth, and the unemployment rate's been very low. And you know, nothing is better for, you know, for the middle of the income distribution than seeing sustained low unemployment. And wage growth, although it's slowing, is still pretty good. You know, we had a long period after the crash in 2008 where wage growth was less than 3%, and we're way above that now. But you know, the price level shock from the pandemic has scared people and made them nervous and unhappy, and that's one of the reasons why the administration's poll ratings are so low. But actually, real wage growth is, at the moment, is still positive, but it's probably going to get weaker. And as it gets weaker, it just makes people more cautious.
Greg, when you look at these kind of retail sales, do you then expect potential potentially more companies to come out and have to say, I guess we need to start slashing more prices to make sure we can keep some of that market share?
I think you're already seeing it. You're already seeing a lot of companies think about incentives as a way to drive consumers to spend more. And as Ian was pointing out, if you look at the different income quintiles, you're seeing the bottom and median income quintiles being much more price sensitive. What does that mean? It means that they have to get greater focus on how to drive consumers to spend. But you have to do that at an affordable price. And in order to do that, you're probably going to need some incentives. What that means for the overall economy is slower consumer spending and ongoing disinflation, because those price cuts in certain sectors are going to lead to further disinflation. This is actually a positive story. It's a positive story where the Fed has to be careful to recalibrate monetary policy and adjust to that environment and not be so backward looking, because backward looking can be very dangerous in an environment where you have a lot of noise in the data and downward revisions a month later that show a different picture when it comes to retail sales.
Well, and to your point about this isn't necessarily a negative story, this has been one of the key questions for equity markets. Is bad news good news at a time where disinflation can potentially be positive? You could see it this morning, toggling around how to interpret this, basically lower at the moment futures on the S&P, although they were higher. You could see yields markedly lower across the board. This from Drew Mattis over at MetLife, and I think it really crystallizes the fears that a lot of people have. He said it may seem to have been the break month. Lower sentiment, lower retail, higher claims. The question is whether this is going to spiral downward, and if so, when does the Fed recognize it? Ian, given that view that some people have, and I believe you are sympathetic to it, what is the chance of a Fed error at a time where the Fed is looking for December for a Fed rate cut?
Oh, the chance of a mistake is going up, for sure. Monetary policy works with very, very long lags. I can't stress enough how long it takes for the economy to respond to whatever the Fed does. The economy is now clearly softening, but it's 2 years since they started raising rates, 2 years. And that means that if they start cutting rates tomorrow, it will be well into 25 or even 26 before we start to see the upswing triggered by that easing. And so between now and then, potentially, we could be in for quite a long period of sluggish growth. I'm not, at this point, not terrified of a downward spiral disaster, because the private sector's finances are in much better shape than you normally have at the start of a recession. But I can see the risk that the Fed presides over quite a long period of sluggish growth, which is probably unnecessary to get inflation out of the system, which is why I think sometime next year they'll end up with inflation below the target and monetary policy getting much easier. So the equity market is kind of toggling between this bad news is good news because lower rates, and also bad news is bad news because low margins. So there's going to be a real kind of push and pull in stocks, I think, over the next few months, where the rate people are just buy because valuations, and the margin guys are saying, well, hang on a minute, this is a loss of volumes and margin compression at the same time. So it could get a bit sticky.
Greg, final word?
I'll disagree a little bit with Ian for the first time.
All right.
But I think there is a risk that the economy actually worsens more because of the self-reflective interdependence between the Fed and financial markets. You have this unhealthy environment where the financial markets are trying to price what the Fed's going to do based on data, which is backward-looking, and you have the Fed that's essentially looking at financial conditions to try to evaluate how tight its monetary policy is. If you end up in an environment where there's a sudden pivot at the Fed because of disappointing economic data that's backward-looking, that could catalyze into something that's more pronounced in terms of financial markets, seeing this as very bad news and thinking that the Fed is seeing a recession down the road, and you could have this negative feedback loop that weighs on the economy. That's a potential downside risk via the financial markets channel.
The game theory of what we see with the markets and the Federal Reserve. Greg, Ian, both of you, thank you so much for being with us. Ian Shepherdson of Pantheon and Greg Daco of EY.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.